So 2 colleagues, 1 question, where do I start? One of them knew a little and one of them knew absolutely nothing. And it was the same answer for both. 3 funds, that's it. And in this episode, I'm going to tell you exactly what those funds are and why I recommended them and what I wish someone had told me before I had made the same expensive mistakes of my own. Now I do need to say this. This channel is not financial advice. I am not qualified financial advisor. Everything here reflects what I do, what I have done, and what I'm going to do with my own money. It's not a recommendation for anyone else. Investments can go down as well as up, and your capital is at risk. Always do your own research, and for regulated advice, consult somebody qualified, and not someone like me, who's from a council estate in Stockton-on-Tees. So recently, I saw a clip from Martin Lewis, talking about stocks versus leaving money in the bank. And then I went to the comments, and what I saw told me everything about where most people are with investing right now. People want to invest. They know they should, but they're paralysed by the jargon, by the fear of getting it wrong, by not knowing where to even begin. And that gap between knowing you should do something and actually doing it costs people thousands of pounds over a lifetime. The answer is simpler than most people think. But first, let me tell you what happens when you do not start simple. Now, I did not start with ETFs. I went straight into individual stocks and I made a mistake that is still sitting in my regular trading account to this day. A UK property trust focused on regional office and industrial space. The yield looked exceptional, the Motley Fool articles were positive and very plentiful, and everything was pointing to a holding that would pay me reliable income for years. And over a period of time, I put in over £7,100. Then COVID hit. Offices emptied, regional property got hit hard. Regional REIT never really recovered. That £7,100 is now worth £639, and I'm still receiving a dividend. Now, I haven't sold it. Selling would mean that I'm crystallising a loss. And the £639 that it's worth today is not going to do anything meaningful for me if I did move it elsewhere. So it sits there as a reminder. And that's what happens when you concentrate risk into a single stock you do not fully understand. Chasing a yield that looks too good to be true. Now, I'm not embarrassed about it. It's part of the journey. And apart from Fauci and Gates, who else knew that there was going to be a pandemic? But it is exactly why I did not tell my 2 colleagues to go and pick individual stocks. So the lesson, diversification, is not just a word financial advisors use. It is the thing that stops one bad call from wiping out years of progress. When you own one stock, you own that company's problems. When you own hundreds of companies through a fund, one failure is nothing more than a rounding error. So knowing what I know now, I sat down and thought about how I would start if I had my time again. And this is it. 3 funds, simple, diversified, and backed by decades of evidence. So let's get into the 3. First up, VUSA, Vanguard S&P 500 ETF. Now this tracks the 500 largest companies in the United States. Apple, Microsoft, Amazon, Nvidia, all of them. In one fund, the S&P 500 has returned an average of around 10% per year over the long run. I'm not picking winners, I'd be buying the whole market. When the US economy grows, my portfolio would grow with it. Second up, VWRP, Vanguard FTSE All-World ETF. Now this is the accumulating version. If VUSA gives you the US, VWRP gives you the whole world. Over 3,000 companies across developed and emerging markets. The US still makes up the largest chunk, but it also gets exposure to Europe, Japan, and Asia. If I did only want one fund, this is it. It is as diverse as it gets. And then thirdly, VHYL, Vanguard FTSE All-World High Dividend Yield ETF. Now this is the income version. Same global diversification, but filtered for companies that pay above average dividends. You get exposure to high quality dividend payers across the world, and those dividends land in the account regularly. This is the bridge between pure growth and an income-focused portfolio. But then there was one more, for the one with the mindset. He asks the right questions, he's thinking longer term, and he's not looking at the price every time he has his phone in his hand. The Aberdeen Asian Income Fund, ticker symbol AAIF. It's a closed-ended investment trust focused on income-generating equities across Asia. It trades at a discount to the net asset value, the yield is attractive, and it adds genuine geographical diversification away from the US heavy weighting you get in the global ETFs. Now this is a step up in complexity, but for someone ready for it, it is a strong addition. Now before we go and buy anything, get the wrapper right. Now, this is the most important thing. In the UK, the answer for most people starting out is a stocks and shares ISA. Everything inside it grows tax-free. No income tax on dividends, no capital gains tax when you sell, and you can put in up to £20,000 per year. Do not invest outside an ISA until you have filled it. It is the single best tax advantage most people never use. 3 funds, a stocks and shares ISA, and time. That is the simple answer. If you want to open an ISA and start with any of these funds, I use Interactive Investor and the link is in the description. It is where my ISA and my SIP have both sat, and I've been on this platform since 2017. Now subscribe if you want to follow along as the portfolio grows, and I'll see you next time. Bye bye now.